So Daniel will chime in as we go through the presentation. We'll do this fairly quickly because this is background material, but there is a impossible to read bill that's introducing not only what we're going to talk about, essentially capital gains and trust tax amendments that are coming in force, but the talks about negative gearing and so on. So the explanatory memorandum is 100 and a little over 100 pages of gobbledygook. So that's very difficult. How they're going to affect this legislation, given what has already been identified as difficulties with what they've proposed, and taking into account a Treasury consultation paper which floats quite a number of ideas and says they were inviting submissions on them because they may do this or they may do that, but they're not quite sure what they'll do. It's going to be, I don't think, eye-watering perhaps. So anyway, so as I say, this reform bill introduced and now passed with amendments from the Senate, is introducing basically a minimum tax of 30% distributions of net income from discretionary trusts that are not fixed trusts. We'll talk about that later. The tax that's being introduced is to be payable by the trustee of a discretionary trust, and on distribution of income out of the discretionary trust to a beneficiary, the 30% tax paid by the trustee will be creditable by the beneficiary to the share of net income. Well, I call it share of net income because that's how it's been in the law up until now, although these provisions are now foreshadowing, we're talking about share of taxable income, and the accountants among us will know the difference between what we call distributable income and taxable income. I won't divert into a discussion about that difference, but that's the first of the notable difference. So the credit that the recipient beneficiary can claim is a non-refundable credit. So it can absorb the 30% can be credited against the tax liability of the recipient beneficiary. But if that credit is greater in amount than the tax liability of the beneficiary, there will be no refund. Contrast franked dividends from the company, where if the franking credit's not fully absorbed by the shareholder, in their tax liability, the excess franking credit can be refunded to the shareholder. So there is a very important exemption. A distribution by the trustee of a discretionary trust who's paid their 30%, which vests in a company, what we've called the bucket companies. What goes into a bucket company will be fully taxed at 30% with no credit for the 30% paid by the trustee. So immediately there will be a 60% rate. The 30% paid by the trustee is not a deductible amount. So the amount on which the company would stand to be assessed will be regardless of the fact that 30% is being paid. So if there's $100,000 coming out of the discretionary trust to a company, 30,000 will be paid by the trustee as tax, 70,000 comes to the company, the bucket company, but it will be taxed on 100,000. So cough up another 30,000, 60,000 so far of tax, then distribute to a benefit to a shareholder of the bucket company. You have top up tax, which is then an additional. If you're 47% taxpayer, this is putting it crude because there's a gross up and then a rebate down, but another 17%, if you like, for a top marginal taxpayer, taxpayer, on top of the 30 plus 30 plus 17% of what's left. So you get about 70% tax rate. Or if you can't frank because the bucket company had losses, then you're getting up towards 80% tax rate, all of which politicians think is quite reasonable. And they wonder why we announce people. Anyway, so and that minimum marginal rate of 30% will apply to capital gains as much as it applies to income. Now, for capital gains, there is to be a valuation opportunity at 30 June 2027. So out of the discretionary trust, or at the time of 30 June 27, the CGT assets, capital gains tax assets, can be valued, and the 50% general discount that presently applies to capital gains within a discretionary trust and reiterates when those gains are distributed to an individual beneficiary of the discretionary trust, they will in that sense be preserved on assets that will be held for more than 12 months. So, that is in a sense preserved by being able to be valued and notionally the discount, the 50% discount applied. Thereafter, gains are said to be able to be indexed, and indexation can be applied to the cost base of the asset to allow for further discount. But I'll explain well, that may be illusory in many circumstances, but nevertheless, the government's inviting a raid on valuers. Already, it's nearly impossible to get a valuer to do anything quickly, but we're expected to get valuers to run around and value things by 30 June 27. You can, at the time an asset's realised, it will be possible to get a retrospective valuation, but the date for the valuation is 30 June 2027. So that's, I think, that pretty broadly the starting point. I said I wouldn't talk a lot to some of these slides because the policy reasons can be summed up, notwithstanding all of the nice palaver that goes with them, as in 2 words, in 3 words: blatant tax grab. There's nothing really less to say about it than that. And you'll see in various circumstances why I say that. In essence, out of what's there, the point is that for taxable incomes of recipients' contributions out of the discretionary trust, you essentially won't be able to absorb the 30% as an average tax rate until you get to about $240,000. Anything less than that, the 30% will be an increase in your tax in the flow through of income and receipt. Fast readers, if you're finished. Or these proposals went to the Senate, and the Senate, as has been fairly well publicised, affected a number of exemptions. I think the exemption for primary production assets, however, they're going to be defined. The statement presently is that everyone knows what farming is. So they've got a long history, so you should know what that means. Well, we'll see what the definition is, I suppose. Bob Hawke thought that racing horses was farming, but maybe other people won't think that way. Also, from the outset, there was intended to be exemption for new residential housing, but that's another ill-defined in detail concept. Affordable housing, exemption for complying superannuation funds. In the Senate, they pushed in the income from testamentary discretionary trusts, but there's a complication in that that's always existed. That's only from the assets in the trust, not from bringing more assets into the trust. Of course, what you'd like to do is, well, you wouldn't like to do because you'd be dead, but someone else would like to do. Talk about early stage investor startup business shares, which is obviously political because there's no reason for why, if you make a capital gain out of investing in early startup companies, you shouldn't be treated any differently from making investment in anything else. But that seems to, the risk to reward ratio is inherent in the investment, you would think, but the government has bent to criticisms there. Adjustment for deductible donations, well, that's because if as I said, you're about to get 230,000 distribution, but you reduce your tax by giving 50,000 deductible donation, then you're going to pay, you're going to not get the benefit of the 30% credit for the trustees' minimum tax payment. So presumably when the legislation comes out, there'll be an explanation of how you add back to for beneficiaries of discretionary trusts income the amount that they donated to a tax deductible charity, not a foreign one. So, and the small business, there are a whole lot of against this small business so-called concessions. I love the word concessions when it's really with your money, the government's taking out its tax, and when they say that we're not giving anything back, that's a concession. So their small business concessions turnover threshold for important instances has gone from 2 million to 10 million, but not always.
That's for the purpose of the small business 50% reduction. The turnover's been increased from 2 million to 10 million. But of course, in looking at other small business CGT concessions, your retirement exemption, your 15-year exemption, that up to threshold is going to apply.
So you have to be a very small business nowadays to have less than 2 million turnover. So, and the Senate, the Greens decided to ban limited recourse borrowing by superannuation funds, which really the purpose of residential housing investment, which really had nothing to do with anything of this, but was opportunistic. So the impact's going to be pretty significant. Don't believe the government's figures. There's probably more like close to 1 million discretionary trust lodging tax returns at present. There might be 350,000 active small businesses, but it takes no account of large investment portfolios and large operating private businesses. So they say that 210,000 are expected to pay additional tax. Well, I think that was absolutely minimal. And there's a few calculation that says, well, that's not going to affect 90% of businesses, which of course counts mum and dad, those in the company, etc., already. So that's another piece of gaslighting. So I really don't need to dwell on that. So the government's the budget paper really tries to sell this also on the basis that, well, if you're a small business, you can roll yourself out of your discretionary trust into a company, and if you're a base rate taxpayer, your tax rate will go down to 25%. Of course, that ignores tax on dividends when they're taken out, and let alone tax that might be if you take money out without purely ranking dividends. And there's always a problem about something like this. If you roll over into a company, you've got income in the company, you want money out of the company, you don't get a franking credit until you pay tax, which you can perhaps pay quite considerably later. So you can't frank a dividend, so you have to borrow under what's called a Div 7A, Division 7A complying loan agreement, and then you're into the next year before you can take a dividend and square off what's called the minimum annual repayment under the complying loan agreement. So why do I talk about this? Because it's just all this complication that's being loaded on people over and over again through the tax laws in my short time. The tax law has gone from one little book like that to a series of books like this, and this will add another one. I'm running out of shelf space. Okay, so so where do we go here? So the minimum tax outline is this one. I've talked about how the 30% comes in. Indexation being talked about is a comparison. If you've rolled out of your discretionary trust into you're able to roll out into, you're now in indexation, or you can look back, because if you look back far enough, there's indexation, then there's not indexation, and then there's 50%, and then you're coming back, and I've only told 3 times. I mean, you can iterate more than that, but the comparison appears to be, but yet to be advised and detailed. CPI, say, you're taking your 50%, CPI at 1 July 27 to CPI number.
Yeah.
To that at the last quarter of realisation time. So when eventually you trigger a capital gains CGT event, which would ordinarily be saying disposal, signing a contract to dispose. So and you come in for 50. You come in with the ability to index through that period that I've just mentioned, and on that basis, it appears. And I mean, for most people, 50% will be better than kind of claim indexation over the full period of ownership. If that's what, in the end, you're going to be able to do. This is my do-nothing position. Due to my own circumstances. Yeah. So what I'm saying is, well, if you had a beneficiary who got 18,200, they would have paid no tax at all. Now there'll be $5,575 tax on their 18,200, courtesy of the 30% tax levy. If you kick it up to 45,000, which brings them into the away from the zero tax land, then they're going to pay 4,000. They wouldn't pay 4,500. They'll pay 15,000. So that's a kick up of 10,000 in that band. Or if you had 3 grandchildren that you were giving $1,000 a week to out of your discretionary trust, and you're wearing 8,407 in tax, well, now it's going to cost an extra 8,800 for those 24,000, a little more, 26,000. So and so on until you eventually get to break even at about that figure that I mentioned, say between 225 to 230,000. So there's serious penalty tax on low income earners receiving income through a discretionary trust as a result of this this change. And call that what you will. I might get arrested. So as I say, the government's keen for us to roll over into a company. So all's well. You can roll over and keep your 50% discount as at 30 June 2027. In fact, you can even choose not to roll over at that time. You can choose to roll over for 3 years, right up to 30 June 2020. What the benefit of rolling over the value at 30 June 2027 less the 50% general discount, and then taking indexation for the next 3 years is in rolling into a company. And I don't know. I mean, it's a number on a piece of paper that washes away, I think. I'll tell you why shortly. but the thing is, the idea is, all right, well, you can roll over into a company. You do have, if you're then in a company, either you're paying 30% on your net income anyway, or you might be able to pay 25%, as I said, if you're a what's called a base rate taxpayer, base rate company, which is a small active business. So I won't go there. That's another discussion. But so the government wants you into a company, and everything's going to be taxed at 30%. Your net income, your capital gains. That will generate franking credits. So and that depends on how valuable they are, depends on who the shareholder is. If the shareholder is a discretionary trust, you've just rolled out of the trust into the company, or the CGT assets out of the company, just in the company, and you still got the same shareholder. As I said a little earlier, your franked dividend will get applied against the minimum tax rate, if there is a minimum tax rate in your discretionary trust. So you'll just get a non-rebatable credit, a non-refundable credit back to the beneficiary to the trust. So that's not really going to change your exposure to the minimum tax rate in discretionary trust. The government's saying, well, there'll be new rollovers. To my mind, there's some point in thinking about existing rollovers. There are rollovers already in existence under the capital gains tax regime. There's one for small businesses, which is, I'll subject you to the numbers, subdivision 328-G of the Income Tax Assessment Act 1997. As you all know, we had two acts because they ended up halfway through rewriting and gave up or ran out of money. So 328G is limited to businesses with less than 10 million turnover. And it's got some funny restrictions, like it has to be done for quotes unquote genuine business reasons, not artificial tax reasons. That's in the legislation. And the Commissioner has expressed his view of what that means, which is essentially whatever I want it to mean. And then there's also not to be any change in, again, quotes unquote, ultimate economic ownership. And the assets have to be quite active. So, you know, on the face of it, that was an attractive rollover. But in reality, there was a bit of a surge of using it, but most people have lost interest in it after that.
Can be hard to do as well, John, through discretionary trust, sort of demonstrating maintenance of the ultimate economic ownership. You've got a family trust election as well.
That's right, and it tended to be turn on the family trust election, which is probably very possibly something you want. So, and then there's subdivision 122A, which is a bit like I was postulating before, where you've got a discretionary trust, transfer all your CGT assets or an asset, it doesn't have to be all in this case, into a company, but the discretionary trust has to be the shareholder. So
is that 30%? tax on the tax.
Yeah, so you're back in that scenario with a minimum tax. And if you try and wriggle your way out of that by issuing shares in the company against the discretionary trust shares, you have to be careful or you'll run into a value shift. And that there will be an assessable capital gains tax in itself on the down value of the discretionary trust shares in the rollover company. So you know, what might seem like a good idea, I'll issue a dividend act, what we call dividend access shares, and surely that's only enabling a streaming of income on these dividend access shares. But the ATO will quickly argue, well, they seriously reduce the value of the rest of the shares in the company, so we've triggered a CGT event, and they'll be taxed at that point. So, so differential rights to dividends in your rollover company under 122 raise is problematic. Anyway, so now we're invited to a more generous regime of new rollovers. So you can roll over, the thought is when you can roll over not just to a company, but to anyone, pack of individuals or a single individual or 1+1, whatever the case may be, in whatever proportions you like. Or you can roll over into what they're calling a fixed trust, and you'll get relief. And the only thing you have to maintain is there needs to be through the recipient group or group a ultimate economic ownership, no ultimate economic change of ownership.
It's the same family. So.
Yeah. So look through to what do you have the same family unit at the end of the chain or not? So another thought bubble had yet to be fully open. I mean, with a lawyer's hat on, how you move from a discretionary trust into a fixed trust is an interesting proposition, because you're not supposed to be able to affect the discretion of the trustee of the discretionary trust. So if you vest it, that's not going to work. That's not exactly a rollover. That's the end of the trust. And if you transfer it, well, the federal government hasn't let the state government in on the party, so you better not have what are called non-qualifying land assets, like residential land or primary production land, because you'll trigger liabilities for stamp duty. And if there's land to be conveyed, you'll trigger a liability for transfer fees anyway.
Could be ad valorem.
Yeah, so there are all sorts of incidental fees that can be triggered out of this without just focusing on the Commonwealth legislation.
Sorry, John, so nothing has been said yet about rollover, because presumably many people are going to have trust with residential property.
Yep.
So if they do seek to roll over into a corporate structure, has anything been said about the stamp duty?
No.
In fact,
that's a major issue, and more so in the eastern states, because while we do have no stamp duty on business assets,
Yeah, but
and no stamp duty on qualifying land. In the eastern states, there are not those exemptions.
so state government has said nothing about the stamp duty on
Well,
normal real estate residential.
if salivating is saying nothing, that's easy.
Right.
All right, so yeah, so and they are talking about small business CGT concessions being retained through the rollover process. So the parameters. Sorry, I might have lost my place in all of this excitement. Yeah, so I think I've really covered these. I was just saying that these can be to individuals or so-called fixed trust. As Daniel said, we've got the same family unit test, and here again there'll be foreshadowed. There'll be retrospective denial of the rollover if there are changes in membership of the rollover entity within a period, because what you might like to do is roll over into a company and have individual shareholders, but then change back to some other bring in the discretionary trust, because if you've got enough income, you might be happy to have the 30% washout, as it were, and flow through, because you've got average marginal rate of tax of 30% anyway, if you're pushing through a discretionary trust. So what that period is, we don't know. In these rollovers, the 328G had the same idea. It had if you went through a period of stability for 3 years, then you passed a safe harbour rule. So they might consistently, as I've said, the base their 28P rollover. So we might have a 3-year safe harbour period. I don't know what they say about marital breakup or new blended family or someone dying with it or someone having a baby, but hopefully, or illegitimate one. Hopefully there'll be some sense in all that. They've already been called out it being pointed out that on jointly owned assets where there's a succession, that on the face of it, this tax is triggered, and it's been called a death tax. So the government's said, oops, we'll run away from that. Rollover consideration, you don't know. If you're going into a company, 122A, as I said, you have to have the existing owner of the asset become the shareholder in the rollover company. Here they're not saying that. So it's likely, I mean, there will be restrictions, and I'm pretty sure they won't allow redeemable preference shares.
So Sage, on that fourth dot point from the bottom,
Yeah.
is pretty interesting, where there's this push to have predictable economic entitlements that are based on rights attaching to the shares, as opposed to entitlements based on discretionary allocation. So if there was a school of thought that you might roll over into a company where you've got shareholders holding different classes of shares with differential rights to dividends, that's it, stamp it out.
Yeah, and that's to all income and to all capital as well. So So it has to be fixed right across the board, or you're not going to get your rollover. So I think the rest of it, I'm just talking about, well, what consider 22A rollovers. Another aspect is that the shares that you get out of the rollover company need to have the same net value as the assets, less liabilities that go in. But 122A does allow the rollover company to absorb liabilities that are attached to the assets. So that we don't know if that can be possible, but that's an interesting situation if they can be attached. And I'll tell you why in a moment. This is, I think, significant to people. If you're thinking about rolling over into a company, it's all very well to be able to, for the company to be able to claim against the capital gain it realises the 50% discount that the discretionary trust could have claimed, now only up to 30 June 2027. The company can claim that now, but that won't produce any franking credits. And the company from 1 July 27 can't claim indexation. So the gains, so you're talking about, I'm just talking about this 50% that won't be taxed in the company, but it produces no franking credits. So when it's distributed out to shareholders, it becomes taxable. So the idea of saying, well, we'll preserve your 50%, now roll over into a company, well, thanks for nothing, because when the 50% discount comes out, you're going to be fully taxed on it. Now, that might say, the government might say, oh, well, roll over into an individual and you'll be all right, or a group of individuals. But who particularly wants to fix the shares of all those discretionary beneficiaries that you used to think about, with daughters-in-law or sons-in-law or whoever it might be, that or even grandchildren that you're prepared to give a few bob to out of the trust, lock them in. One thought that I have had was, well, and we'll see how the legislation pans out, but if you do have a discretionary trust, it is possible with this commission that doesn't like this, I must say, it's possible to revalue the assets, and carefully, because this is, you're weaving your way through some provisions of the capital gains tax legislation, but vest the revaluation amount in a beneficiary. That is not, because the gain hasn't been realised, it's a revaluation gain. It's possible to create a liability to the beneficiary in whom you vested the revaluation amount. If you can then roll over subject to that liability, then the company would be able to pay out that liability out of the 50% protected amount and avoid the dividend trap. Now, just what beneficiary you'd be giving the revaluation amount to would be an issue in itself, probably, and on what terms. If that manifests itself in a loan, that might be subject to a variety of preconditions about being paid out, but it would still nevertheless be a liability. So I found it hard to come up with something that would challenge the tax commission. And bear in mind that he doesn't like that. Yeah, another which there is no slide is sort of trying to work double rollovers, so that you roll over and roll over again. But the commissioner, I won't go into that because the commissioner's got a draft part 4A ruling against double rollovers. So we need to see what that says before you go down that dangerous route. I mentioned that there's contemplation of rolling over into a fixed trust. What a fixed trust is defined by exemption. A fixed trust is something that's not a discretionary trust. You would think in the ordinary course that a standard unit trust where people took up units in a sense as almost a proxy for taking shares in the company. And the trustee defines something like people, each unit holder is entitled pro rata to their income and pro rata to a share of the income and share of any gains would be a fixed trust. But no, the High Court saw one of those in MSP nominees and said in passing, well, that's a discretionary trust, not a fixed trust. And the commissioners happily leapt on that with a practical compliance guideline saying that, yeah, that's right. In order to be commissioners sort of started from the position, well, nothing's ever a fixed trust unless it's virtually a bare trust. And even then the commission tried to put out a ruling on what was a bare trust, and that's about 15, 20 years ago, and still hasn't ever seen light of day. Be turned from a draft into a final rule. But so what the Treasury consultation paper says is, we will define what a discretionary trust is. So wait and see, but that's going to define what a fixed trust is. So it's a bit difficult to tell you, to plot out for you what a rollover into a fixed trust might look like. The fundamental legal concept is that it's you have a vested and indefeasible interest. And that derives out of an old English case, Saunders and Gautier, in which there was a gift to an individual in a will, subject to obtaining 25 years of age. But on the end of obtaining majority, he demanded that the subject matter of the bequest be paid to him, and the court said there was no basis for restraining him from being paid. So there's been a need in various circumstances to wrestle with Saunders and Gautier, particularly in drawing wills. But the courts have backed off somewhat from that from the proposition by saying, well, if there's a right of indemnity for the trustee to be paying money out of the assets of the trust, then that might mean it's not a fixed trust. Well, that exists. That right pretty much exists by law in every trust. So it'll be interesting to see how the Treasury and the government define a fixed trust, and given that nothing is a fixed trust by law on that basis.
because applying that thinking, John, to unit trust action, so what we could be forgiven for thinking why is my interest in the unit trust not vested in it feasible? The ATO would say is, well, we're under the trustees, you've got the power to vary rights attaching those units or to issue other classes of units or more broadly to amend the trustee eroding that concept of having vested in a feasible interest.
Yeah. So what the rollover into the fixed trust is going to amount to and how it can be done, is anyone's guess in a sense. The consultation paper that the Treasury put out on the maximum minimum tax on discretionary trusts calls for submissions by tomorrow, by 31 July. Someone said to me that they'd been to a meeting where it was said that, the submissions are due by 31 July. The legislation's already been drafted and it's scheduled for being presented to Parliament in 14 days. So time after that, good luck with your submissions. And even with the negative gearing legislation which came out in May, the Law Council Tax Committee, this Law Section Tax Committee, which I have been a deputy president here, put in a 25-odd-page submission shooting as many holes in it as a column that they're charged ahead notwithstanding. So well, we're going to talk any more about this. I think we've already covered this. So
John, are you suggesting that the definition of discretionary trust is going to capture unit trusts as well? From what?
Yeah, well, the unit trust is by.
Well, we're talking about by definition, so it actually will be subject to the 30% tax rate.
Yeah, and which is going to be pretty horrific.
Well, I'm thinking a lot of super funds own property through unit trusts.
Well,
that's going to be absolutely
compliance to the funds are exempted.
No, but they're holding units through unit
but
trust.
holding units in the unit trust, so that it'll be
Being exempt.
tax and then
How does that?
non-revertible, reverted, but no refund. So that will be serious. I mean, the position with unit trusts, even if they're not held, the unit's not held by super fund, they're likely to be held by discretionary trust. So you've got level one and then level two in the discretionary trust, where you're getting a rebate and having losses in discretionary trust. And then if they come out from that, they better go to an individual. The income better go to an individual that's going, or a super fund if you like, because it's going elsewhere. You're going to lose the benefit of having paid 30% in tax. So we won't talk any more about that. The valuation issue, I think we'll talk largely about. It's all very well for the government to say, well, you can value your assets, but over the years, a significant amount of dispute that I've been involved in for taxpayers has been arguing with the ATO about valuation of businesses. The old capital gains tax rules exempted goodwill or differentiated plant and equipment. So if you could get a high valuation on goodwill, low valuation elsewhere, you were advantaged. but the ATO would constantly argue the opposite of what the taxpayer wanted to argue about valuations in that context. And then there'll be difference between market value of land is probably not so difficult. It's market value of businesses and intellectual property and so on. It becomes more difficult because you're trying to maximise your value at 30 June 2027. And the Commissioner will be, for a while, no doubt, be wanting to reduce your values. And there's a limit in it. If you write over in your company, you're not going to get any indexation anyway. Right. So you obviously, if you want to have maximised your cost base, as it were, and you want to maximise your pre 30 June 27 bank. Trust to trust distributions. I think we've talked about that. Not doing too badly in the time limits. All over or summary, or other thing I've gone through that. And there are exclusions, but for most of us, that's probably not going to be particularly relevant to us. The widely held trust complying superannuation fund, disability trust, deceased estates, charitable trust, primary production is significant, and so on. And we'll see what they do with early stage investing and or speculative investment of that kind. The exemption to testamentary trusts is a bit interesting in that if everything is to come to an individual in their very late years and they've done and their wills full of testamentary trusts, then they're only by the simple method of dying. They'll be able to circumvent these minimum tax amounts, non-rebatable minimum tax amount, or non-refundable. So for a very few, there might be some sort of estate planning strategy available.
The third dot point's interesting as well. You carve out to the 30% minimum tax, where the testamentary trust established on or after 1 July, I think it can only benefit individuals or income tax exempt entities. And there's the question of what is established. Is the date the will is made? Is it the date the estate has been finally administered and the assets handed over to the trustee? I've got a testamentary trust drafted now with a broad class of beneficiaries that would extend beyond that. That could impact.
So in the last minute, here's a contract. Past indexation was on a quite different basis to this. Resident exemption for new residential investment. There's a complicated method statement now to be applied, which is going to have something of the effect of where you've got losses to be applied, reducing your ability to benefit from the 50% discount. So that's in the weeds, and that's really illustrated by a calculation which I didn't do anyway. So So the qualification of indexation, and it's not a good enough reason to return to the past at all, because you're just trying to grab tax. Yeah,
Have you guys made a submission to Treasury at all about this?
no, we.
And it's not working.
Oh, no, but the Royal Council is making a submission, and there's some very erudite members apart from me on that, or more erudite than me.
Is there any chance this might get shelved because it's so bad?
Oh, no. The only way to get shelved is a change of government.
So will they chat? So have they actually said that they would get rid of this legislation?
Angus Taylor said they'd repeal legislation.
I heard he said that on the rental properties,
Yeah.
but not on this. So he has said it on this.
I know you're I don't know. I just heard a speech that he made straight after the original legislation.
Because he should be pressed on that. You know, that if this gets through, that they would repeal
Well,
this.
it's going to be massive disruption. If I think about a business, it's operating, and many are operating. So trust, not small business, would say medium-sized business with more than 10 million turnover, for example. I mean, to go to your customers and say, now I've got a new entity, go to your suppliers and say, I've got a new entity. Restructure your staff payroll because you've got a new entity. Go through your audit chain on supplies with a new, now you're supplying to a new entity. So we've got to do the whole audit chain all over again. Go to your refinance, and you know, it's like just putting your head in the mouth of the dragon. Because everyone that you go to deal with will say, oh, the old trading terms, now they have new trading terms. This, and for what? It's illegal for what? For the government. It's a tax credit, of course. From the rest of business, it's just another massive cost, and what's the productivity?
Two things. It does seem like there'd be something besides a tax credit. It seems like they've got to be for doing this particularly stupid type of tax credit.
Well,
But the second part is that I've always thought of trusts as the safe bit because that's the way the politicians are using their looking after themselves.
yeah.
So how have the politicians escaped this, or are they shooting themselves in the foot?
Well, they don't need to. I mean, what's the base salary? $250,000 or something. They're probably paying an average rate of tax, apart from their allowances, of down near 30%. And same for the vast number of the 1,120 or whatever is employees of the Treasury. So anyway, but I mean, when it came back to that, people wage earners are paying 4%. Well, you're paying 4% less tax than wage earners, and so it's a doctrinaire thing for some reason, which I think just being in the end kind of brings disrespect to the tax. Whenever the tax system starts to overtax people, which is really the major problem with the tax system, probably 7% is just too high a rate of personal tax. So whenever the tax system's overtaxing people, they're looking for whatever way they can find to not be taxed at that level, and in the end, I'm not going to pay those superannuation, this change, that change, with everything that regulation and for. Now we've got to take it up to some new tribunal and say, oh, I'm sick of it. It's too hard and it's too risky. And they want me to be lost. kind of lavishly paid Commonwealth employment job. And enjoy my work from home 2 days a week and here is me. Yeah.
Out of curiosity, where do block of units stand as in residential, or like in the eyes of the ATO, as in residential or commercial, say for the super, for instance, on borrowing capacity, or so is what are block of units classed as in the eyes of ATO, residential or commercial?
So you're building what home units being occupied or?
Yeah, so say I've got a apartment block with 50 units.
Yeah.
Which I own. Is that, or can I buy that in the superannuation? Or is that classed as residential and therefore I cannot borrow?
You cannot borrow, you cannot do limited recourse borrowing through the superannuation fund.
Yeah, because depending on if it's residential or commercial.
Yeah, residential you can't, commercial you can.
Correct. What is it?
So
Block of units?
characterisation of a block of home units that are rented out. I would think if we took residential investments, and aren't they trying to stop you from buying established residential property? But I don't know what the limited recourse. I mean, I know what the general state is, which you and I just shared, but how that pans out through definitions, can't tell you at the moment. That's also promised, I think, for residential, non-residential, new residential, existing residential. I think that was in the bill. I haven't focused on.
I know that I think that the Senate amendments would have sent out limited the recourse borrowing residential.
Yeah.
There was a concern that for negative gearing purposes, so that's the amendments that they passed.
Yeah, I don't want to tell you an answer where I don't know exactly what is correct. Yes.
Do you think there's going to be another unintended consequence of this if people are moving like medium-sized businesses from a trust into a company and then they go to apply the 15-year rule down the track because it's not the same entity that's owned it?
That's the ultimate economic owner group you're talking about. So if that changes, if there are changes in the shareholding of the company.
No, so you've just got the trust, testamentary trust that owns, or no, a discretionary trust that owns business.
Yep.
And that gets rolled over into a company.
Yes.
These sorts of purposes, and then that person goes to retire in 10 years' time.
Yep.
And you've got your 15-year, CGT
Turn
role.
that back to the original acquisition.
Or are they going to say no, different ownership structure, and then?
Well, the asset that you're talking about is a share owned by the owner, or are you talking about the company? Who's realising? Are we realising the business, or are we realising the share? You're realising the business, I think you're saying.
Yeah.
So, the 15-year rule.
There's some special timing rules where you can sort of look back to the original acquisition, but I think that one would hope that it's dealt with as part of the rollover provisions that are rolled out. I mean, in the legislation that's been passed, you're disregarding the deemed sale and acquisition for the purpose of looking at the 12-month rule and also applying the small business concessions. But your question's a different fact scenario, so one hope that
I mean, there's a.
It's not clear. I think
There's in the death, the rollover on debt provisions. There's a deemed continuity of ownership, but I've got a feeling it doesn't apply in the context you're talking about in the in the small business CGT session.
Can I suggest that if you make any of those concessions, that you actually trigger them now, not the rollover? So you actually sell it into the company and you trigger those capital gains now, so then your cost base is in the company with higher value.
Well, that's one thing to look at, and it's like looking at whether you use a different rollover or whether you actually crystallise
Realise the CGT, yeah.
Yeah. That's going to be relevant for quite a lot of people because they might not receive further gain, much in the way of further gains. As we've seen that they've got most of them at this point, most of them they're likely to get. There's going to be a lot of numbering. So, because quite a lot that way, which way? Thanks, all.